Welcome to the latest market update with me, Andrew Dawkins, and
myself, Daniel Bajwoluk. Hello again, Andrew.
Hello again, Dan.
Another month?
Yes.
Here we go again.
Yes. Well, let's have a look. We had January and February, which were both negative months for the portfolio. We talk in these videos really about the portfolio performance, which applies to a lot of the funds that we use and also a lot of the funds that we give advice on. So January and February both negative months, and then we had a rally for March, and then April has seen what do you think?
Stagnation?
A stagnation
of sorts.
It's heard of stagnation.
Up, down? Is it being leveled off?
It's level, yeah. I think by and large the month of April for us has been a level month, which I suppose after what we've seen at the beginning of the year is quite an achievement. So we'll take that, and of course we have to take that.
And so how have the markets reflected what's happened within the portfolios then over this previous month?
So I think the star of the show for this month has been commercial property, and as you know, the commercial property funds that we use tend to be outside the UK, and they've done very, very well, up just over 4% this month, which is good. I think it really reflects as well the fact that if you go for quality, then quality office space is still very much in demand throughout the world. It's that thing, location is the big thing for that. Also as well, the Far East has been quite a good performer, up just over 3%, which is a change for most of the year, because I think over the last 12 months or so since we've been doing this, the Far East has been a bit of a lagging rascal, but this month has been positive for that. Europe and the UK, fairly flat month for both markets. We're still getting over the effects of inflation, quantitative easing in the UK being reduced, and interest rates probably going to be rising in the Eurozone. America has been a disappointing month, and it's actually our laggard of the month with a negative return of around about 2%, largely on the fall of the big tech stock over there. But again, most of the companies declaring profits just at the moment, or results, are actually showing quite good numbers. Microsoft numbers were out recently, and they're showing mighty good growth. Apple as well. Apple, though, issued a bit of a warning about costs increasing due to supply difficulties, putting aside between $7 and $8 billion to go in the next quarter, where they're finding that actually getting goods out of the factories will be a bit of a challenge because of the shortage of raw materials. Interest rates as well in America on the rise, and quantitative easing getting eased. So cutting back on that, which then causes the market some sort of upset. The fixed interest market has generally, it's been a month where the fixed interest funds, that's lending money to companies, and gilts, which is lending money to governments, have actually increased ever so slightly.
Wow.
Yeah.
It's been a while since we said that.
It is, isn't it? I mean, still over the last year and 2 years, a lot of the funds there are showing negative returns. And I think that's one thing that we want to bear in mind if we're looking at making money for clients over a period of time, is that traditionally the more conservative, safer types of investments are actually over a year or two probably actually delivering worse returns than an equity-based portfolio. So there's a bit of a reappraisal about risk, and you know we've been banging on about this for the last 2 or 3 years. A lot of our portfolios, we've been sort of keen to keep fixed interest exposure very much to a minimum.
What's happening different in China than over here in Europe and the UK?
Well, it was the Asian market in particular, so China's a part of that, obviously. But in China, they don't have the same worries as we've got regarding inflation. Their inflationary pressure isn't half as bad as it is here. And what the government's recently said is they're quite prepared to actually stimulate the market and put more money in there if needed, because they have huge foreign reserve currency. So they can get out a heck of a lot of money and really stimulate the market in the way we can't do here because of the quantity of government involvement that there's been recently. The markets are awash still with very, very sort of cheap forms of cash here and in America. So China's got one over the rest of the world, I think, that it can actually stimulate the market if needed. The other thing which is probably working against it at the moment is the zero COVID tolerance. We've still got Shanghai, city of 17 million people, in lockdown, and the fears that spreads to Beijing and other major cities as well. So I think the markets are worried that a zero COVID policy in China, given that that's a huge manufacturing base, still has difficulties for the rest of the world in terms of getting products to the consumer, and that then increases inflation even further. So it's a difficult one over in China in terms of this strategy for zero COVID, and it just shows that COVID is still having an effect worldwide, and specifically here in terms of inflation and not being able to get the goods as quickly and as easily as we used to be able to.
Speaking of inflation, which you've mentioned before, and the rising interest rates, here closer to home, the general public, I guess that's what's on their mind just now, just the cost of living going up. So what should our clients do at this moment in time? What would you recommend for them to do when it comes to their portfolios?
In terms of the portfolios, then it's short-term inflation can be overcome because of the fact that if you invest in good stocks which are capable of beating inflation, then it's all very well and good. But over a period of time, even the best companies, they can only pass on price increases so far before the consumer says, well, I simply don't have enough money in my back pockets to actually pay for your goods in the first place. So it is more of a worry. But generally, it's looking at those assets which can either keep pace with inflation or even potentially outpace it. And that is certainly not a case for cash. Cash we do recommend if somebody's wanting to hold an asset for say a year or a few months, or if they're needing money to use within the near future. But generally, as an asset class, it isn't something that keeps pace with inflation long term. So it's reviewing portfolios, reviewing assets. But there isn't really much to be done because of the fact that we're very careful about the assets that we include within our portfolios, and those individual funds we recommend as well, because what you want to be able to do is to be able to design a portfolio for all weathers, really. And if you invest in quality, then you should see that come through in times of uncertainty, just like these.
And now we'll look at the A.R.D. Consultancy Portfolios over the last month, year, 3 years, and 5 years.
So our defensive portfolio over the last month is down 0.5 of 1%. Over 1 year is down 3.3%. Over 3 years up 7%, and 5 years up 15.7%. The cautious portfolio is level for the month. Over 1 year it's down 1.9%, 3 years up 11.4%, and 5 years up 24.1%. Our balanced portfolio over the month down 0.1%, over 1 year down 1.5%, over 3 years up 17.2%, and 5 years up 34.6%. The capital growth portfolio over the month up 0.1%, over the year down 0.6 of 1%, over 3 years up 22.4%, and over 5 years up 45.5%. And finally, the aggressive portfolio, this month we're up 0.4%, over the year we're up 0.9%, 3 years up 34%, and 5 years up 58%.